This episode of FinCrime Unfiltered with Sarah Beth Felix is brought to you by Castellum.ai, the real-time AI agents and screening platform keeping banks, fintechs, and governments ahead of financial crime. Whether you're navigating sanctions or watch lists, Castellum.ai helps you move fast and stay compliant. No outdated databases, no manual processes, just lightning-fast intelligence you can rely on. Visit Castellum.ai to see why compliance teams are making the switch. That's Castellum.ai. Hello and welcome to FinCrime Unfiltered. I'm Sarah Beth Felix. This is episode 23. Thanks for joining us. And we've had a busy week, even in despite the U.S. Government shutdown. We've had a lot of activity from our federal banking agencies. So we're going to talk just briefly about some of those things to watch out for. There's been some, I would say, baffling bulletins, if I was trying to be good with letters, baffling bulletins. So the Office of the Comptroller of the Currency, OCC, had a pretty busy week. They kept, I think there has been 7 bulletins that they've released, or at least 7 press releases just in the past few days. And first it was the model risk management guidance, which I was, glad to see a formal statement from a regulator, specifically the OCC, about the, misuse of former capital markets model risk management that they have long been silent about. And I don't think that that is a good way to apply, or a good thing to apply to AML systems. But they didn't go as far as I wanted them to. I was hoping that they would say, hey, this old capital model risk management guidance that we've had for decades that everyone has been conflating with an AML system model risk management guidance does not work. I was hoping they'd say something like that. But instead, they basically just came out and said that model risk management guidance, that they will not provide negative supervisory feedback to a bank solely for the frequency or scope of the model validation. And, I felt like, it kind of left me wanting a little bit, as did many of their press releases this week. But if you're an OCC bank, or if you're an FDIC or Fed Reserve Bank, and you've been using model validations on a yearly basis, because that's something that your regulatory examiner has expected of you, I would not just automatically start removing that from your budget for next year. I would make sure that your system is effective first and foremost. I know that a lot of the guidance, and especially the stuff that came out this morning from FinCEN, which I'll get to in a little bit, really kind of leaves us with some knee-jerk reactions. So I would encourage you, if you are an OCC bank, or if your examiner has had this expectation that you have yearly model validations done, before you start changing that, I would encourage you to outline the reason, right, for why you're going to stop doing this. But please make sure you don't list clean audits as a reason. Please make sure that you use more substantive information, like the effectiveness of your system, how that has increased. There's been no severe changes in your customer base makeup. There's been no severe changes in your transactional landscape, nothing like that. I think those are the things that needs to go, that needs to be the focus of a memo to justify the end of ongoing model validations. But let's not take our eye off the prize, and I will say this multiple times today, the prize being providing highly effective, timely information to our federal law enforcement partners. That is why we do what we do. So while they are removing the formal expectation of an annual model risk management, validation of some kind for your sanctions and AML system, it doesn't mean that you just take a hands-off approach and that you just hope and pray that your AML system is finding what it should be finding. Especially if you are a New York-based OCC bank, you also have the New York DFS requirements to deal with as well. So don't get too focused on what the OCC is saying. So I believe that was October 6th that they released that. October 7th, they then talked about, quote, unsafe or unsound practice clause. So that's a clause that you see a lot. And this was actually jointly issued by the FDIC and OCC. And what was interesting about this one is that they explicitly stated that this should only be used, that this term, unsafe or unsound practice, should only be used for financial material risks. To me, that's dangerous. So those particular terms, unsafe or unsound practice, are actually found in over 90% of our public AML-related consent orders over the last 3 years. I actually went back through all the PDFs I had from from the end of 21 to 22, 23, and then all of 24. And over 90% of them had either unsafe or unsound or both of those words used in an AML-related consent order. So I think the desire by this current administration and who they have put in place to, kind of ease some of the burden. I feel like the people making these decisions have actually never been in this space. They've never been an AML officer. They've never had to write a SAR. They've never had to look at a disposition. And, so it seems to me that these decisions are being made by people that are not related to this actual process at all. So that was the first part of October 7th. And the second part of October 7th, later that day, both the OCC and the FDIC, again, they published a notice of proposed rule making to codify the elimination of reputation risk from their supervisory programs, which they did kind of dangle this several weeks ago. I had posted about it. And really, this is a notice of proposed rule of making, so an NPRM. But this proposed rule would actually prohibit the agencies and examiners from requiring or encouraging an institution to close an account or to terminate a product or service or an account on the basis of a person or a business entity's political, social, cultural, religious views or beliefs. Specifically, they state constitutionally protected speech, or they cannot do any of that stuff. They cannot close anyone out solely on the basis of a politically disfavored but lawful business. And I've said this before in other episodes, we kind of saw this coming, but the way that they kind of expanded on this did not give me the warm and fuzzies. And like I've said in other episodes and in other LinkedIn posts, this type of approach, while I understand the reason for this current administration's take on this because of their view of certain things that have happened and certain people that have been cut off from the financial system, at the end of the day, the operational impact of this is that it will severely limit an AML officer from de-risking a perfectly legal business like a strip club or a cannabis business, like a website that sells adult pornography. Those are perfectly legal, right? But that bank may find that it exceeds their risk tolerance and they don't want that activity there. So now people, and I'm wondering, I'm not a lawyer, but I work with enough lawyers where my brain goes to, all right, so a community bank that opens up a business account for this kind of benign business, and they do whatever stuff online, and then they find out through the course of the relationship what they're really doing online, facilitating different things that present higher risk to them. But because it's lawful, they are not able to actually exit that business. And I'm wondering if this, because it's public facing, will be used to force banks to bank businesses that they don't agree with for whatever purpose. And I feel like that's a pretty dangerous place to be in. And because most AML officers don't have actual real executive authority, they have the illusion of authority, I call it, they actually won't be able to override the board and executive management position if they want to continue banking this. It doesn't matter how much they say, hey, we don't have the right technology. We don't have enough people to bank this risky business. If the board and executive management want to do it, they're probably going to use this wording here in this bulletin as well. So I don't see this ending well, which is unfortunate. But I kind of feel like it's just another kick to the shins, like I've said in other episodes and other LinkedIn posts. This is like the hits just keep coming. The kicks keep coming on this. And while, again, I understand the purpose, they want to make sure that, certain people of certain political beliefs don't get de-risked when there's no suspicious activity. I understand that. But to then go as far as saying socially and otherwise, as long as it's a lawful business, that they have no legal leg to stand on, it is a bit of a stretch. And I think it will present other risks, and it will drive good AML officers out of their position into other financial institutions that will actually give them true executive levels of authority. So I think that's another probably, kind of like a waterfall effect of what's going to happen, especially if banks or boards and exec management actually override AML officers when they're sitting there saying, we don't have enough people, we don't have the right technology to bank this riskier yet lawful type of business. So getting to the actual breaking news was this morning, FinCEN issued an FAQ for SARs specifically. And I will say I was at Atlanta here has this massive high-tech prayer breakfast, and I was sitting there, and they had some great speakers that were talking about things, and my phone dings, and it starts really early in the morning, like 6 a.m. or something, and my phone dings, and I'm thinking, oh, and then I see it's FinCEN, and I'm like, wait, what time is it? And it was like 7:50 a.m. Eastern that FinCEN put this FAQ out, which I thought was pretty interesting. I'm like, great. So they're burning the midnight oil over there. But part of a few things I wanted to bring to your attention with this particular FAQ, because I feel like, again, we're going to have a lot of knee-jerk reactions to this. I did post in length on LinkedIn at I Follow Dirty Money. But for our time today, I at least wanted to make the point that these FAQs are not requiring you as the AML officer to do anything different. There is no requirement for you to change. If you want to keep business as usual, then you keep business as usual. These FAQs addressed structuring, continuing SARs, and no SARs. So those were kind of the three main buckets. I think there were only 4 questions in it. I feel like, again, some of the wording, it was like a, no, you don't have to do this, but if you do it this way kind of a thing, kind of a rope-a-dope. And I do have great respect for folks at FinCEN. I know several of them there, and I know that the intent in this FAQ is probably different than what it's coming off like. But I think there's some areas that we probably need to make sure that we don't just kind of throw the baby out with the bathwater on this. Structuring particularly, let's, again, keep our eye on the prize. Our prize is providing highly useful, timely information to our law enforcement partners. And structuring, I really wanted them to say a little bit more. There was a little blurb in there about how you still need to ensure that the underlying activity is not illicit. And I feel like that needed to be front and center. That needed to be sentence 1 to that FAQ, but also needed to be said again throughout. And that wasn't really it. So if you're going to just throw out the whole structuring rules, you need to make sure that you're solving for both issues of structuring, which is the method by which that they conduct their transactions, and then also the source or the use of funds. Both of those have to be dispositioned. For the continuing SAR activity, I do not believe it means that you don't have to file any ongoing suspicious activity reports ever. I don't think that's the intent of it. I think the intent was probably what they thought was going to be an administrative relief. And what I'm seeing is actually the opposite, because the original guidance from 2000 and as well as 2012 from FinCEN clearly state that the 90-day continuing SAR rule was actually to provide administrative relief. Because if you file a SAR on January 1st, and then 2 weeks later, that same customer flags in your system in an alert for that same type of activity, you don't have to file then. Your 30 days doesn't start then. You can actually wait till the 90 days. So it actually provided administrative relief, because then you can push that off and say, okay, well, this guy just keeps doing this, or this lady keeps doing that. I am just going to wait till my 90-day time frame to start that continuing SAR process. And then now they're undoing that, which to me means we're actually going to have more SARs if you remove that continuing SAR requirement. So again, you don't have to. They're not saying to not do that. So I would encourage you, if your continuing SAR program is working for you, leave it as is. I would not make any changes. For the no SARs, I think this is going to provide a lot of examiner FI battles. I think the financial institutions and examiners are going to battle it out over this one. So the last FAQ, it does not mean that you just get to auto close your alerts or give basic non-answers like not suspicious. That's not going to work. And if you have someone who's lobbying for that, I would not see them as a valuable part of your team if they're saying, oh yes, finally we get to say not suspicious, and that needs to be it. I don't think that's the case. And I certainly don't think that the no SARs particularly applies to alert dispositions. From my understanding, the no SAR guidance that they have in the FAQ4 is actually for those that are cases or possibly prior SARs and you're deciding not to file a SAR again. They do go as far as saying that a few sentences would be just fine. But again, you have to ensure that you have a leg to stand on. So if your examiner comes in, part of what they have to test is the effectiveness of your program and your SAR decision-making capability. So don't take this kind of, shortened answer to FAQ number 4 and say, oh, we don't have to have anything that shows why we did or didn't do something. I don't think that's what FinCEN is going for at all. I think what they're trying to do is make sure that you're not overdoing the no SAR justification. So that brings me to the end of my time today. Hope everyone gets a little bit of a breather. I just can't believe how busy our government's been, even in spite of the shutdown. So thanks for joining us today, and we'll see you next week. And please don't forget to email us at FinCrime Unfiltered at illicitedge.com or find me on LinkedIn at I Follow Dirty Money. Thanks.